So I created a bond calculator here in Excel, and what do we see? We see the amount we lent, and the face value of the bond is 1,000, or we lend out 100,000. The coupon they pay is 6%. The maturity of this bond is 5 years, and the interest rate, or sometimes also referred to as the yield to maturity, or we can call this the discounting factor, is, let's say, 6%. So for instance, if we calculate this, we press on calculate, the bond price is exactly 1,000. So what do we see here? The bond price is exactly 1,000. So is this, let's say, fairly priced? Yes, it is, because let's say all those future cash flows which we see here, 60, 60, 60, 60, and in the last year we get the 60, plus we get our money back, discounted over time. So we know, let's say, this time value of money, future money is worth less in the present because of this time preference of money, for instance, because of, let's say, interest rate risk, maybe default risk on the bond. Inflation has to do with this, so we know that, let's say, those future cash flows should be discounted, and this is the present value of this string of cash flows. This is how it works. For instance, if you make this is a 15-year-old bond, a 15-year bond with a 15-year maturity. We press on calculate. What do we see? Yes, again, the bond price is 1,000. So those future cash flows discounted gives us exactly the issue price of the bond, the par value. Okay, so this is, let's say, our basic calculations concerning a bond. This is how it works. Now let's change things. For instance, when a bond is issued, it's usually issued at this par value, usually 1,000, or sometimes they give you a discount with a discount bond, so they sell it for, let's say, 0.5% less. But if you have a plain vanilla bond, the face value and the coupon are fixed within the contract. But let's say over time, for instance, with a maturity of 15 years, things can change. And what will happen? For instance, if the expectations concerning inflation, because let's say the central bank is flushing the market with money, what will happen to the interest rate? For instance, if the interest rate, or let's say this yield to maturity, this discounting factor, for instance, decreases to 5%. What will happen to the bond price? Press calculate, and we'll see the bond price increases to 1,103 euros and 80 cents. So if the yield to maturity increases, or in the yield to maturity, decreases, what do we see? We see the bond price drop. Bond price rise, bond price rise. So what is, let's say, the economic justification for this? Because let's say we can look at this as a mathematician and say, okay, yes, completely true. If we discount by, let's say, a yield to maturity that is lower, not 6% but 5% in this case, yes, let's say the value is higher. Let's say the economic justification would be, let's say, nowadays the interest rates in markets are 5%. While this bond still pays 6%. So this bond is more attractive. But because the face value and the coupon are fixed, so they cannot change, what should happen to the price of this bond? This price should rise, because this is a very attractive product, which still pays 6%, while new bond issues, for instance, with the same risk profile, pay only 5%. So this is why the price should rise. Now, what will happen, for instance, if the interest rates jump up to 7%. So maybe what would be a feasible story that we would say, for instance, the issuer will get a downgrade, so they are more risky. There is more risk involved for the bond holder. Why? Because let's say there is a downgrade from AAA to BB, so that's a very thorough downgrade. So what will happen? The risk profile changes, and usually if risk profile changes, let's say the investor in the bond wants a compensation for this extra risk. But the coupon is fixed and the face value is fixed, the maturity is fixed, and we assume it's a non-callable option, a non-callable bond. So what will happen? What should happen to the price? We just calculate. We see the price drop. And the economic justification would be, let's say, okay, because the coupon and the face value are fixed, and let's say new bond issues with the same risk profile as this bond pay 7%. To make this, let's say, still attractive to investors, we should lower the price. So the price of the bond is now, let's say, a little above 900 euros. So this is how, let's say, the basic mechanics of bond valuations work. Let's say, usually these things are fixed, so the face value, the coupon and the maturity. The only thing that is changing is this discounting factor, usually perceived as the yield to maturity. And what do we see? We see bond prices rise and drop. If the coupon percentage is the same as the yield to maturity, or as interest rate as it is called in this Excel slide, and we put on calculate, the bond price will always be 1,000. So if we look at this yellow bracket, we see, okay, if the coupon rate is the same as the interest rate, the bond price will be 1,000. If the coupon is below the interest rate or below the yield to maturity, the bond price will be below 1,000. If the coupon is higher than the yield to maturity or the interest rate, as it is called here, the price will be above. Last thing I want to mention is, for instance, bond prices change by changes, for instance, in inflation expectations, by changes in a risk profile of the issuer. But which bond suffered the largest consequences? And what do I mean with largest consequences? Which bond? Longer maturities. So bonds with longer maturities. If we look at this slide here, bonds with longer maturities are more sensitive to interest rate changes. So here another Excel file, and what do we see? If we have a bond 1 and bond 2, the maturity of bond 1 is 5 years, the maturity of bond 2 is 30 years. They have the same yield to maturity at let's say the time of issue, and the coupon is also 5%, so both bonds are priced at 1,000. So nothing changing. So if we're looking here in this graph, we see this large yellow dot. These are the prices of both bonds if the yield to maturity is the same as the coupon rate. Now, for instance, if we look a little closer here, what do we see? For instance, if the yield to maturity drops, and it drops significantly from 5% to 2.5%, so a 2.5% drop, what will happen to the bond price? Now we know if the coupon is larger than the yield to maturity, bond prices should rise. But in our specific case, what do we see? Bond 1 increases, yes, like we expected, but it increases with, let's say, 11.6%, while the 30-year bond increases with more than 50%. So what is the, let's say, the conclusion here? That we should say, okay, longer maturities are more interest rate sensitive. So if there is a drop of, let's say, 2.5%, let's say the 5-year bond increases with 11%, while the 30-year bond increases with, let's say, 52%. The other way around, if you look at this last box, if the interest rate of the, for instance, if the yield to maturity increases not from 5 to 7.5%, what will happen? The price of the bond should drop, because let's say if the justification I just gave, for instance, let's say new issues with the same risk profile now offer, let's say, 7.5%, while our bond is still only paying 5%. So the price should drop. But let's say in our case, what we see here is that, let's say, the 5-year bond only drops with 10%, while the 30-year bond drops with 30%. So we see longer maturities, this should be our conclusion, are more interest rate sensitive. And here I plotted it in a graph, so we can change the maturities. For instance, if we make this 15 years, then we see, okay, still these differences, but let's say the differences are a little less, right? So you can play with this. It's on the T drive, so play with it. So what have we learned? To conclude, bonds are usually issued at par, and par, let's say, is 1,000, let's say at the face value. And usually the coupon is the same as this yield to maturity, or let's say as this discounting factor. But because within a time span of 15 years things can change, so this yield to maturity is the only thing that can change. Let's say the face value, the coupon, and the maturity are usually fixed, and bond prices change. And here in the yellow box we already said, for instance, if the coupon rate is higher than the yield to maturity, the bond price is above 1,000, and if the coupon percentage is smaller than the interest rate, the bond price is below 1,000. And we also learned that if you have a longer maturity, you're more interest rate sensitive. For instance, this is the problem with all Dutch pension funds nowadays. They have these very long maturity investments, and if there are slight changes in the interest rate, because they're very low now, they run into trouble. Okay, I hope this was helpful. Thank you for listening.